Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness Podcast. I'm here with my business partner, Corby McGordon, who's sitting in today for our regular co-host, Walter Dial. Our mission here on the podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building sellable or transferable business value, and then helping you to plan for your eventual exit from the business successfully. We want to help you build a business that is transferable, and we want to help you exit successfully on your own terms and conditions. You may be tuning into this episode as a potential buyer of a business who needs financing, or a seller who needs additional funds for building the value of your business. Either way, it's going to be helpful for you to understand SBA loans or lending or small business administration loans that might be available to you. And so today, that's what we're going to talk about: SBA loans for growth and exit. And our expert guest is Jared Ricks. Jared is the Senior VP and Regional Manager for M&T Bank, Washington, D.C. and Maryland area for M&T Bank. We know Jared well. We know the bank well. Jared and his team do a fantastic job here in the DC area, connecting with the business community and providing access for funding for growth and exit. And we know this from experience. So we're excited to have him with us today. Jared, welcome to the podcast.
Pat and Corby, thanks again for having me, and we're super grateful for the long-term relationship we've had with Ennis Legacy Partners. So thanks again.
Fantastic. Thanks, Jared. Hey, as you know what we do. I just described it, and you guys work closely with us, helping business owners grow and build business value and then plan their eventual exit. Let's start, Jared, with just you giving kind of a high level or overview of M&T's SBA lending practices and your commitment to that market.
Absolutely, Pat. Well, I've been with M&T now for 11 years, and specifically in our small business division. So we're dealing with company sizes 0 to roughly 30 million in annual operating revenue. And the main function of that is helping customers access capital conventionally as well as through the SBA. We also provide some cash flow management tools, but we've been a top 10 SBA lender in the country for 14 consecutive years in a row and running, which we're really proud about. Currently number 1 here in the DC, Maryland area. So we have a ton of experience in the SBA space. Want to give hats off to Christina Smazniak, who's actually our director of our government lending arm, which is up in Buffalo. So that team really helps our team here in Greater Washington on the ground be well positioned for success as far as that direct relationship that we have as a preferred lender with the SBA. And so it's been a real competitive advantage for us to be able to sit down with customers where most of our competitors are solely looking at the deal conventionally for newer borrowers or for higher dollar amounts for customers that are either looking to buy into a business or looking to expand with a larger purchase. Having a relationship with the SBA where we have our underwriting process, but also the support of the government guarantee backing that SBA loan has really, really been helpful. So.
Mm-hmm. Yeah, and to pull on that thread, Jared, so I'm a business owner. Why would I do an SBA loan versus a conventional loan? Can you highlight just what are the big advantages of an SBA loan?
Yep. No, it's a really good question. So, so an SBA loan is typically going to top out, and it's going to cap out at roughly $5.5 million. Mm-hmm. So if a business owner is looking to make a larger purchase than that, typically conventional is going to be a little bit more favorable. Mm-hmm. Another advantage, though, on the SBA side is that we have a little bit more wiggle room and mercy when it comes to credit score requirements. So typically, most of our borrowers, we're going to want to see 720 plus, on the conventional side. If we have an experienced operator, a good business, some cash flow to support it, I've seen some instances where we can get comfortable in the 675 plus range, give or take. So that's been extremely advantageous. The time to fund is something also to think about when you're comparing an SBA loan to conventional. Typically, conventional loan is going to be a little bit quicker. The SBA loan can take up to 75 to 90 days, given the fact that you're going to go through two approval processes, right? So you'll go through the approval process with the financial institution, i.e. M&T, and go through our underwriting requirements. And then we would send the file over directly to the SBA, and you essentially would go through, another underwriting process. Once they give us the blessing, they give us an identification code that we put in the system for the guarantee, and we're off to the races. So that process and the paperwork with dealing with the government can typically draw out the process a little bit longer.
Yeah.
Again, as I mentioned earlier, with an SBA loan, the government and the bank bear the risk, versus with a conventional loan, it's solely contingent upon the bank, right, and us doing our own due diligence. And then lastly, I would say that the advantage to having an SBA loan versus conventional would be time in business, right? So I've seen many cases startups have been able to acquire capital using an SBA loan. And then when it comes to exiting a business, the person looking to acquire, oftentimes we can get them qualified based on projections and a business plan. Whereas on the conventional side, we're typically looking to have a stable person in place for 2 years or greater, looking to see some operating performance. And so projections are not as heavily relied upon as they would be on the SBA side. So I know I gave a couple of different long-winded answers there, but try to compare and contrast SBA versus conventional financing.
No, it's very helpful. And so we're seeing a lot of insider transfers right now where employees of a business are assuming leadership and eventually wanting to buy it. Can they apply for an SBA loan? And what do you look for in that?
It's a really great question, Corby. And we're seeing a ton of that right now as well in the acquisition space. So I think the key thing to first understand is understanding the business that we're dealing with, and how long have they been in business, what's their competitive advantage in the marketplace, understanding the key owners that are currently in place, and are they looking to maintain a percentage of ownership? If they're looking to fully exit and that key employee is looking to step in and buy the business, a big thing that we're really going to zone in on is the owners that are exiting. What was their sole responsibility in ensuring that the business was viable over the years, whether it was a 10, 20, 30-year span? And then backing into that key employee, what are their key skill sets and assets that they're bringing to the table that are going to ensure that they're not only able to fulfill the key responsibilities that they're maintaining today within that organization, but can they fill in the gaps for the owner or owners that are looking to exit, right? Once we can kind of understand those key elements, then some of the things backing into are numerical, right? What's the business plan going forward? Are you looking to maintain the same strategy? Are you looking to go into a new lane and diversify? And then we'll also look at the personal side as well, which will be key by looking at the personal financial statement to see what assets are there, engaging whether or not they'd be a good candidate for SBA or conventional.
Yeah, no, makes perfect sense. It's fascinating that you're starting with not the numbers, but the business itself and who's on the bus and in the right seat. How high is that bar? Like say you got somebody that's been employed for a while, but they haven't actually been running the company. Is that more of a risk for you than somebody who has been, say, director of operations that wants to buy the business? Talk about that key person and what you look for to say, yeah, that's a solid candidate.
Yeah, good question, Corby. I think it's all situational, right? It all depends, right? And that key employee and their experience that they bring to the table, depending on the industry, it could be make or break, right? So if we're dealing with a medical client and, this person right now is a doctor that's on the staff, but they're not an owner, if they've shown an ability to be able to bring in their own patients, right? And we have confidence that they'll be able to continue to grow that, that'll be key. Typically, any key employees that are customer facing as far as obtaining contracts or being able to go out and sell a service and bring it in, us having the confidence that they'll continue to contribute to top line revenue growth, understand how to maintain good profit margins, and then more importantly on the service, being able to collect in a timely manner so that ARs are not going too awry. That's gonna be critical, right? And so sometimes people that have those fundamental skill sets, they may not be hidden within a fancy C-level title, right? They could be someone that's just a key role within the organization. So that's why I say it's situational, depending on the person, and us understanding where is the business today, who are the key players that are looking to stay or exit, what's their ability to maintain, attract, and retain new talent or existing talent. That's also key outside of those owners looking to exit. So our comfort level at which a lot of those pieces will be within the business plan, and then we'll also be able to test through viable projections numerically. I think they all fit into just the sole analysis that we're doing on the individual, if that makes sense.
Yeah, makes perfect sense. Yep.
Yeah. Hey, Jared, are there any restrictions in regard to types of businesses that could be eligible for SBA loans or specific industry restrictions?
It's a great question. So there are certain industries that are ineligible for SBA loans. I would say that the organizations that we come across very frequently that would be disqualified, not-for-profit organizations would be the first organizations that come to mind. So we have to be lending to a for-profit entity on the SBA side. Mm-hmm. Any type of entertainment businesses would be disqualified. Any organizations that are directly involved with gambling or sports betting or any of those types of things. And then lastly, the other common institutions that we run across, any type of lending or insurance type institutions would be disqualified from SBA borrowing at a high level. There's many other industries, but those are the top four that I would say that we see most frequently that would be disqualified.
Yeah.
Okay, and Jared, how about an overview of the types of SBA loans that are available, and then, or the purposes, which SBA loan is going to be best suited for if I'm going to grow my business. So if you could speak to that a little bit too.
Yeah, so the two most common types of SBA loans that we're doing here at M&T would be SBA 7A loan or 504. So on the 7A side, that loan is typically topping out at $5 million. 504 stretches $500 million more to $5.5 million. The 7A allows you to use those funds from a loan for working capital, which you can't typically do on the 504 side. We're typically seeing borrowers or advising them to go the 504 route. It's better suited for land or real estate projects, large projects that involve fixed assets, are typically going to be done on the 504 side. And the typical financing general rule of thumb there is the bank would finance 50%. We'd partner with the CDC for the other 40%, and then the borrower would come to the table with 10% cash injection. It favors startups and smaller businesses, owners looking to work with the bank. The eligibility requirements are pretty straightforward on both of those, but that's typically what we're seeing. The biggest misconception that I see with borrowers with both products is that there's automatically an assumption that they only have to put 10% down for an SBA. While that's a minimum rule of thumb, we do exercise our own discretion. As I mentioned, with the two underwriting processes, it's not uncommon for a financial institution, based on their analysis and assessment of risk, to say that they would like the borrower to come to the table with a little bit higher cash injection. It could be 15%, it could be 20%, but 10% would be the minimum there. Two other loans that we see in the market but are not typically bread and butter for us. The SBA Express loans are pretty common out there. Under the 7A. So those are loans up to $500,000 on the Express side, and typically used for working capital or term notes. And then another product that we typically see, especially with a lot of government contracting, would be your cap lines, right? So cap lines are lines of credits that go up to $5 million. They top out at $5 million, and that's typically used for any type of short-term operating capital needs, so revolving or non-revolving. And most small businesses will qualify for that as well. So SBA 7A, 504, and then, for your smaller borrowers, the Express, and then cap lines, which we typically see with a lot of government contractors.
Mm-hmm. And Jared, you mentioned, the down payment side, which I was going to ask the question of, but if I'm a borrower, what else am I bringing to the table? Again, brain's still on the insider guy. Personal guarantees required. If somebody's been with the company a long time, is it always going to be a personal guarantee?
Yeah, no, it's a great question, Corby. And that's a question that comes up a lot with our small business customers. And so again, we're typically dealing with borrowers that are 0 to roughly 30 million in annual operating revenue.
Yep.
And I'll tell you, almost 89% of the time, a personal guarantee is required, right? Typically in the small business space, the business and the individual running the business go hand in hand, right? When they start out, there may be some commingling of personal and business assets. But as that business continues to scale and grow larger, in the event of a default, it's a lot easier for a small business to transfer assets from from their business to the personal side. And so directionally, we kind of look at the personal and the business as hand in hand, right? So we typically will require personal guarantee. Business financials are always going to be something that we're going to want to take a look at, whether it's a business that's an established business that we're looking to extend financing to, or one that someone is looking to acquire. For the guarantors that are coming to the table, typically anyone that owns 20% or greater is what we would classify as a guarantor. We'd be looking at the personal financial statement. So that personal financial statement is not only going to show us the assets and the liabilities that individual possesses, but there's also some questions on there that ask about criminal history, any types of bankruptcies. Have they ever done business with M&T or any of our subsidiaries? So that'll be key. On the SBA side, especially for acquisitions, resumes are key, right? So it goes back to your initial question earlier around what is that string of experience that gives us the confidence that if you're coming in to take over an organization, just because you weren't a CEO before, there may be viable skill sets that we deem credible for you to take over the helm of that organization and continue to steer it in the right direction. On a buyout of a business, we definitely will want to have a business valuation done to solidify the fact that the value that you're saying, or whatever the seller's selling the company for, we just want to make sure that business is worth what you say it's worth and what you're willing to pay, right? And so we have a short list of preferred business valuation companies that we turn to, and that are also approved by the SBA to get that done on the SBA side. If real estate's involved, appraisals are obviously going to be key, environmentals, and depending on the age of the property, we'd also want to see a property condition report. We talked about a business plan earlier, Corby and Pat. The business plan is critical, especially if you're looking to acquire. We want to know what's your strategy moving forward. And baked within that business plan, we typically like to see 2 or 3 years of financial projections in the form of an income and a balance sheet, so that we can back in based on where the business is today. Where do you plan on taking it numerically? And we typically like to see it in year 1 broken out by month, right? So for all 12 months, and then we will accept annualized numbers in the form of projections going out for the remaining 2 years. And then your normal standard business legal documents, EIN numbers and everything else would be required. So that, at a high level, those are the key items that we'd be looking at application to get approved.
Mm-hmm.
You're reading my mind, by the way. So I was going to ask about, the business plan, and a lot of owners, they hear this idea, and you can go everywhere from the 200-page business plan to the 3-page executive summary. If an owner's listening and has to do one, where would they go to know what you look for? How good is good enough?
So I think there's a couple different resources out there, right? So we've seen some of our borrowers that hire consultants that specialize in writing business plans. Because let's face it, our owners may be experts at whatever industry that they're in, but they may not be the most eloquent writer, right? They may not know how to put together projections. So I think that's where having that team of trusted advisors, it could also include your CPA, right? Who knows the business or may already be working with the business that you're looking to acquire. So surrounding yourself with the right professionals. There's also baseline templates that we have access to as well. The SBA has some guides out there on effective business plans and some of the key elements that would be required within that business plan that we would be looking at a baseline minimum. And then lastly, I would say, having a good banker, right? Having a banker that has experience, that's seen these things before, that can collect the package from you, sit down and read the business plan and come back and say, hey, Corby and Pat, before I fully submit this loan, here are the 2 or 3 key elements that are missing within the business plan, and asking and positioning you for the best chance of success when it comes time to go for approval. So, trusted advisors, public resources and documents that are out there, and then obviously leaning on the financial institution or banker that you're dealing with for approval.
Great. Yeah, and if I could plug M&T, it's one of the things I've had the pleasure of working with M&T a few times, putting together these kinds of projections, and that has been the experience that I think it's one of the reasons why you guys do more SBA loans than anybody else, because you're working with owners to actually help them get prepared what you need to give them a loan.
It's what we do appreciate that about M&T. You guys, Jared, you and Efrain and others, you're good sized regional, but you do act like a community bank a lot in these situations, and you've been real easy to work with as we've prepared these kind of things for clients to come to M&T and apply for lending. Can I go back for a second to structure of a deal with an insider transaction in the down payment? Because the down payment, oftentimes most often the folks, the insiders, they don't have the money. They may be entirely capable of running this business, and sometimes even more so than the current owner, the founder of the business, but they don't have the money to buy it. And even to the point where they don't have down payment. So coming up with the down payment can be a stretch for some folks. And talk about whether or not that down payment could be self-financed by the selling owner.
Yeah, it's a great question, Pat. And oftentimes when we're in a situation where we're dealing with an acquisition, I'll speak on behalf of M&T. We see it as a strength if we have a seller that's willing to come to the table to offer seller financing. And especially in this environment right now where interest rates are high, the economy has some uncertain blemishes in it. It's not uncommon for sellers to work with the buyer to come up with a structure that makes sense in the form of a seller take-back note. Some of the things to be mindful of, obviously, we would want that note to the seller to be fully subordinate to M&T's, right? So in the event that there was a default, we wouldn't want the seller finance note to take precedent over ours. Mm-hmm. The second thing is the reason why we like it is because oftentimes we've seen that sellers that are willing to take a seller finance note back and hold it, they're essentially saying, hey, I'm not going to get all my money unless you are successful as the new business owner coming on board to take over the business, right? And so there's typically more of a vested interest in them, introducing them to all of the suppliers, helping them maintain the relationships, giving those warm introductions, and going above and beyond from a discretionary effort standpoint to ensure that that new owner is well positioned to be successful, because if they're not, the bank doesn't get paid and the seller doesn't get the remaining funds that are held back as well. So there's all different types of ways that we could take a look at that, but we're very familiar with doing seller take back notes in acquisition situations.
Mhm. Good.
So once a loan is in place, Jared, are there requirements of an owner to interact with the bank, covenants, all those things? Are they pretty much similar to a conventional loan? Are they more onerous? What's it look like
Yeah.
once one's in place?
Yeah. So once the loan is in place, there's typically a requirement on an annual basis to receive financial statements 90 days after fiscal year ends. Right. And we have some borrowers that end at the end of December, some end at the end of June. But whenever the fiscal year ends, 90 days after the fiscal year, we'll receive the financials, and our bankers will sit down and analyze the financials. And we're really reviewing, and there's a bunch of hypothetical examples, but let's say we're 1 year from doing a loan for a borrower to acquire a business, right? A big thing that we're looking at in your review is the business on par with hitting the projections that they gave to us in the business plan, right? If they're not, it's not house on fire, but it does warrant us to have a discussion to understand why, right? Did we get off to a slow start? Did we lose some customers in the transition from previous owner to new ownership? If that's the case, what's the plan to dig yourself out of the hole and to ensure that the business continues to remain viable? So I would like to say on an annual, kind of just do a high level safety inspection. And then typically for a loan, we're looking at 1.1 to 1.2 times debt service coverage. So for every dollar of debt out there, we're looking for $1.20 in worth of revenue to cover off on it, right? And so we'll do our debt service coverage ratio based on the financials for that year. We'll document it. Obviously, we're a highly regulated institution. And we continue to move on. I'll say the last thing is that a big part of the annual review is not also risk management is a key function of that, but we also want to be proactive advisors with our borrowers as well, right? So oftentimes we'll see financials, and so we're proactively having conversations with borrowers around other products and services that they could take advantage of, or things that they should just be mindful of. So,
yeah, no, that's very good. And in passing, you said the debt service coverage, is it 1.2 times EBITDA or 1.2 times the revenue?
1.2 times the EBITDA, correct? Yes. Yeah. So that's typically the way that we're looking at it. There's different rules of thumbs in this environment. I would say is a little bit more volatile, right? So I've worked in banking where we've used 1.1 times, but I would say in general 1.2 times is what we'll be looking for on the debt service coverage side. And we're looking at projections. We would be looking at projections that align with that as well, right? So there's oftentimes acquisition scenario where debt service coverage doesn't meet that, but we have projections, or with startups as well, right, that don't have a proven track record. We'd be looking for those projections to align with that debt service coverage ratio.
Yeah. Yeah. And then along that lines, so say it is a startup, and, you know, I'm a forecaster, so it's educated guesses, right? And so if things start out, but they're starting out slower, and it just becomes problematic to make payments, can a loan be refinanced, reconfigured? What does that look like, particularly like in a startup or an acquisition type scenario?
That's a scary question, Corby. I'm already bald. I can't afford to lose anymore. But, no, listen. I mean, obviously, our team is on the relationship management side, right? So we're going out, establishing relationships and cultivating healthy ones on the front line. However, we do have a special assets group within the bank that has a team of well-equipped relationship managers as well, right? And so that team is they specialize in working out, special agreements with borrowers that may be experiencing distress, or they may be getting off to a little bit of a slower start. It doesn't mean that the loan needs to be charged off, or we need to stop, cut the loan off. But it may be that we need to be a little bit more creative in that special assets group to ensure that that business, we're not putting too much strain on the business keeping their doors open, but also ensuring that we get paid back in a timely manner. And so I'll tell you, throughout my 11-year career here, there's been a lot of different scenarios where I've seen borrowers that need a temporary special arrangement from a loan structure standpoint. They go to special assets, and then once they turn it around and they're doing lights out again, they come back to us on the front line, right? And we continue to grow and maintain that relationship. So obviously not the most favorable situation that we look for when we're bringing on a new borrower, but we do have a group that's well equipped to work with you.
Yeah. Yeah. It's good to know. And just again, for listeners, the idea, Pat said it in passing, M&T is a sizable bank, but it still functions like a community bank. Relationship is just so key here.
Yeah. So Jared, this has been fantastic, as we knew it would. Going to wrap up here in just a second and ask you if there's any last words of wisdom that you would have, or if there's anything you'd like to promote today and your contact information. Before we do that, though, Corby, take a second or a minute or two and just describe, if you would, when we're working with owners who this is the right route for them to go down, selling, or it seems so, selling to insiders, an internal transaction. How do we help them test the feasibility of it from a financial perspective?
Yeah, what we do is we do the very things Jared's talking about. We establish current value. We look at historical performance that drove that value. And then key to it all is where's it going to go? Because the math really works if a business continues to grow. If a business diminishes in its performance, that becomes problematic. So we model out what the future will look like, and then really wrestle through the reality of that to see what does cash flow look like. So when we get to Jared, we can prove to him that we're not blowing smoke, that there's a well-grounded rationale behind projections that would say, yeah, we're all confident that we can do this as far as we know, which is the best we'll do. But all too often there's a well, we need this much money, and yeah, everything's going to be hunky-dory and continue on. But I think even the points that Jared hit on are what happens when different people walk into management. Relationships are different. Sales ability, skill sets, they're different, which can really affect the ability to perform. And it's a win-win when everybody walks in eyes wide open, and just has the hard facts behind them. So we want to lay out the numbers for the next 5 years and say, does cash flow support a loan?
Right.
Jared, we think it does. It makes their job easy.
Yeah. So listeners, if you're at all thinking that a sale to insiders is going to be a potential exit route for you, now's the time to start doing this analysis and forecasting and starting to get everything in order so that you can walk into Jared's office with conviction and confidence and well prepared. So, okay, Jared, any last words of wisdom from you? Anything that we failed to ask you that you think is important that you should mention here at the end before we wrap up?
Listen, I think this is a really great conversation, and if the opportunity was extended again, we'd love to come back. I'd just say for all the listeners, you guys couldn't ask for better advisors than Ennis, right? And so that's a start. It makes our job easier on the backside, on the financing side, when you start off and surround yourself with very, very strong partners. And so I'll close with just saying, it's not just about the transaction or the loan at M&T. We really are a relationship-driven bank. And throughout my career, oftentimes our best customers are customers that we said right now is not the right time, right? And 2 or 3 years down the line, we've been able to execute and get the deal done for them. Or if we weren't able to get it done, we were able to make recommendations to advisors that can help get them over the line. And so that's the number one thing that I would stress with us here at M&T is just relationship is key over transactions. So really appreciate you guys inviting me out today, and look forward to doing it again soon.
Outstanding. So Jared, if someone listening wanted to reach you, how could they do that?
Sure. So best would be my email. So jricks@mtb, that's M as in Mary, T as in Tom, B as in boy.com. You can also find me on LinkedIn. So that's Jared with 2 R's, Jarred, and last name Ricks, Ricks.
Fantastic. Okay, great. Thank you. Thank you, Jared. And listeners, if you want help with any of this, anything that we've talked about today, or with maximizing the value of your business or planning your exit, you can reach Walter Dial, who's usually here with me at 301-951-9090, or you can reach Corby and myself at 301-859-0860. If you've benefited from today's episode, please consider liking it and sharing it on social media as you see it there. And thank you for listening. And until next time on the Exit Readiness Podcast, Pat Ennis with Corby McGordon signing off.